The copper to gold ratio is a historically validated inflation versus deflation signal, to break it down into very generalized terms. And the copper to gold ratio is at a record low or very near record low. It's been hitting record lows, which is not a good sign. And when you say that, a lot of people say, oh my God, does that mean we're going through another 2008 again? Because the copper to gold ratio is below where it was in March of 2020. It's below every single day in 2008, 2009. Does that mean the market is saying when you put copper together with gold that it's expecting a crash? Really, the record low copper to gold is just like low interest rates into the future. They're basically telling you the same thing. The market is preparing for lack of upside and a whole range of potential downsides. But, again, it's not like somebody goes on, there's not like some website that we can go to that, everybody who's been investing in copper and gold tells us why they're hedging using gold. We have to sort of infer into these market prices and in these changes what it is that these markets might be afraid of moving into the future. We don't have that information. We don't have enough information about that, but we do have enough sense of how things have progressed over the last really year and a half, going back to around March and April of 2024. You can kind of see things be really, I hate to use the word accelerate, but because, if you're going along at 2 miles an hour and you accelerate to 3 miles an hour, that is acceleration. That's kind of how it feels in the real economy. But there has been some acceleration to the downside in a lot of different ways. It's not just related to tariffs and trade wars, just the lack of forward momentum across the entire global system, rising unemployment in a whole lot of places, including the United States. So there is enough information that suggests that we're moving in the wrong direction, even if it doesn't tell us exactly how we get to that last mile period. But again, that's consistent with a copper to gold ratio that keeps going lower and lower and lower. That's the market more betting on the gold side of it, less on copper. Which, copper being a real economy, physical commodity. If, the economy was picking up, we would expect copper prices to vastly outperform gold, but it's been the other way around. So, everything that we're getting, including fears over maybe some credit market dust up, would be consistent with a copper to gold ratio that keeps going down and down and down, consistent with lower interest rates. So there is a lot of that consistency, even if we don't have the full complete picture of what that looks like in the end anyway. Not that we should expect that to begin with. I know that's one thing I do want to mention here is that you go back to 2008, it was kind of the same progression. It wasn't until, Lehman Brothers really failed, really AIG, that anybody really had the sense of what was going on. It was still kind of the same thing. I mean, you go back to 2008, people in the middle of 2008, the Federal Reserve in the middle of 2008, didn't even think the U.S. was going to experience a recession that year. They thought that Bear Stearns represented the absolute bottom. That was the worst case. And it really didn't become absolutely clear to most people until the fall of 2008. I think the credit markets had a better sense.